Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cdw Corporation Annual Report. Cdw Corporation offers a wide range of information technology, IT, solutions across various segments. The company operates through three main divisions: corporate, small business, and public. These divisions cater to different types of customers, including businesses, governments, educational institutions, and healthcare organizations. The company provides both hardware and software products, as well as integrated IT solutions that include on-premise and cloud capabilities. Hardware offerings range from notebooks and mobile devices to network communications, collaboration hardware, data storage, servers, desktop computers, and other equipment. Software products include cloud solutions, software assurance, application suites, security, virtualization, collaboration and productivity applications, operating systems, and network management. In addition to product sales, Cdw Corporation also offers a range of services, including advisory and design, software development, implementation, and managed services. These services are designed to help customers implement and manage their IT solutions effectively. The company also provides warranties for its products, offering customers peace of mind and protection against potential issues. Overall, Cdw Corporation's offerings encompass a broad spectrum of IT needs, making it a one-stop shop for businesses and organizations seeking comprehensive IT solutions. Cdw Corporation's stock price has experienced a significant drop of over 32% in the past year, primarily due to several key news events that have raised concerns among investors. One major factor contributing to this decline is CDW's lowered revenue guidance. Following its third-quarter earnings report, the company's fourth-quarter revenue guidance fell short of expectations, signaling potential future financial struggles. This outlook likely led investors to reassess their confidence in CDW's performance. Analyst downgrades and market concerns have also played a significant role in the stock's decline. Investment banks such as Morgan Stanley and BofA Securities have expressed doubts about CDW's future prospects, citing challenging conditions anticipated in 2026, including reduced hardware budgets and inflationary pressures on memory costs. These downgrades and market concerns have contributed to the downward pressure on the stock, ultimately leading to a significant drop in its value over the past year. Cdw Corporation maintains a market capitalization of $16 billion, broadly in line with the industry peer group. Cdw Corporation trades at a lower price-to-earnings ratio of 15 times and a higher price-to-book ratio of 6.22 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 2.02%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Net income experienced a slight decrease of 0.9% between 2024 and 2025, dropping from $1,077.8 million to $1,066.6 million. However, this decline was offset by the recognition of unrecognized tax benefits, which added $15 million to net income. Profit margins also underwent changes during this period. The gross profit margin decreased by 20 basis points, falling from 21.9% in 2024 to 21.7% in 2025. Meanwhile, the operating income margin dropped by 50 basis points decreasing from 7.9% in 2024 to 7.4% in 2025. The reasons behind these changes are multifaceted and complex. Increased competition and reduced prices have put pressure on profit margins. Additionally, dependence on vendor partners has led to reputational harm, increased compliance costs, and unintended consequences of AI adoption. Rapid technological changes and unforeseen product developments have also introduced inventory risks. Furthermore, volatility in the technology industry and macroeconomic conditions, as well as supply chain disruptions, trade restrictions, and tariffs, have all contributed to the decline in profit margins. The stability of gross profit margin, at around 21.8% for 3 years, suggests that while there are challenges, the company has managed to maintain a relatively consistent level of profitability. However, the decrease in operating income margin highlights the need for the company to address its operational efficiency and reduce costs. The company is indeed generating positive operating cash flow. This can be seen in the various financial statements and summaries extracted from different pages of the report. According to page 27, the net cash provided by operating activities for both 2025 and 2024 was substantial, with $1,205.2 million and $1,277.3 million respectively. Similarly, on page 32, it is mentioned that the free cash flow for 2025 and 2024 was $1,088.1 million and $1,154.7 million respectively. Furthermore, on page 44, the operating cash flow for 2025 and 2024 was reported to be $1,432.8 million and $1,123.9 million respectively. Although there is a slight decrease in operating cash flow from 2023 to 2024, as seen on page 47, the net cash provided by operating activities for both years remains positive. Additionally, on page 63, it is mentioned that the net cash provided by operating activities for 2025 and 2024 was $1,234 million and $1,045 million respectively. These figures indicate a consistent trend of generating positive operating cash flow over the past few years. The company's debt level has undergone a notable decrease over the past year. As of December 31, 2025, the total long-term debt stood at $4.6 billion, marking a 17% drop from the previous year's figure of $5.6 billion. This reduction in debt is a positive development for the company. However, despite this decrease in debt, interest expenses have shown an increase. The net interest expense rose by 6% to $13 million in 2025 compared to the previous year. Furthermore, the total interest paid by the company has also increased, from $217.5 million in 2024 to $234.3 million in 2025. It is worth noting that while there are no clear indications of significant changes in debt level or interest expenses, some pages suggest potential risks due to interest rate fluctuations and new credit agreements with variable interest rates. Nevertheless, the data indicates a slight increase in interest expenses despite the reduction in debt. Management is optimistic about the company's outlook and strategy. They plan to grow through strategic investments, acquisitions, and joint ventures, capitalizing on the increasing demand for IT driven by emerging technologies like hybrid and cloud computing, AI, and more. The company has multiple avenues for growth due to its diverse customer base and strong relationships with major vendor partners. Management is committed to investing in enhancing the company's capabilities and driving profitable growth through sustainable competitive advantages. They are enabling customers with AI solutions, delivering advanced digital transformation solutions, and helping them improve business outcomes through scalable and secure technology implementations. The company expects to continue advancing IT system transformation initiatives, focusing on productivity enhancements and high-quality customer service. Management plans to further invest in AI capabilities throughout its operations and enterprise to drive scale and efficiency. With adequate sources of liquidity and funding available, the company is well-positioned for future growth and success. The company has demonstrated its commitment to returning value to shareholders through various means. One of these methods is by paying dividends, which have been authorized for distribution in both 2025 and 2026. The dividend payments will be made quarterly, with the first payment scheduled for March 11, 2025, and subsequent payments on June 10, September 10, and December 10 of that year. In 2026, a single payment is planned for March 10. In addition to paying dividends, the company has also been actively involved in share buybacks. On February 5, 2025, it authorized an increase of $750 million to its existing share repurchase program. This move indicates the company's intention to utilize its resources to purchase back shares from the market, which can help boost shareholder value and potentially stabilize stock prices. Supply chain disruptions pose significant risks to business operations. The company's operations are vulnerable to various disruptions that could impact its business. One of the primary concerns is the potential for supply chain disruptions, which could be caused by factors such as vendor-partner relationships, wholesale distributor relationships, and product availability issues, page 10. Additionally, outsourcing arrangements with third-party partners may lead to service failures or disruptions due to natural disasters, adverse occurrences at facilities, or equipment malfunctions, pages 2-4. Disruptions in commercial delivery services could also have a material impact on the business, particularly if strikes, inclement weather, or other service interruptions occur, page 15. Furthermore, fluctuations in foreign currency rates and geopolitical tensions can harm international commerce and the global economy, affecting the company's reported results of operations, pages 16-17. Inventory volatility is another concern due to supply chain disruptions, delays in order completion, shortages of product components, and potential finished goods shortages, page 17. However, there are no significant concerns about inventory buildup. Overall, the company must be prepared to mitigate these risks and adapt to changing general economic conditions that may influence its supply chains, page 26. That concludes the financial summary for Cdw Corporation. Feel free to comment below, and I will be happy to answer them when possible.